Let's talk about financial management. The objective of this section is to understand why financial management is important in today's competitive economy. Financial management can make the difference between success and failure for both large and small businesses. Managers must find the money needed to keep a business operating and fund all the goals and objectives that a successful business wants to achieve. Fortunately, the number of businesses filing for bankruptcy has decreased compared to the large number of firms filing bankruptcy during the worst part of the recent economic crisis, as illustrated in Figure 16.1. Financial management consists of all the activities concerned with obtaining money and using it effectively. To some extent, financial management can be viewed as a two-sided problem. On one side, the uses of funds often dictate the types of financing needed by a business. On the other side, the activities a business can undertake are determined by the types of financing available. Financial managers must ensure that funds are available when needed, that they are obtained at the lowest possible cost, and that they are used as efficiently as possible. They must also ensure that financing priorities are established in line with organizational goals and objectives, spending is planned and controlled, sufficient financing is available when it is needed, both now and in the future, a firm's credit customers pay their bills on time and the number of past due accounts is reduced, bills are paid promptly to protect the firm's credit rating and its ability to borrow money, the funds required for paying the firm's taxes are available when needed to meet tax deadlines, and excess cash is invested in certificates of deposit or CDs, government securities, or conservative marketable securities. In the wake of the crisis that affected both business firms and individuals, a cry for more regulations and reforms became a high priority. To meet this need, President Obama signed the Dodd-Frank Wall Street Reform and Consumer Protection Act into law on July 21, 2010. Although the U.S. Senate and House of Representatives debate additional regulations, the goals are to hold Wall Street firms accountable for their actions, end taxpayer bailouts, tighten regulations for major financial firms, and increase government oversight. There has also been debate about limiting the amount of executive pay and bonuses, limiting the size of the largest financial firms, and curbing speculative investment techniques that were used by banks before the crisis. The Bureau of Labor Statistics projects there will be about a 7% increase in the number of jobs in the financial sector of the economy between now and 2024. There are many different types of positions in finance. A chief finance officer, or CFO, is a high-level corporate executive who manages a firm's finances and reports directly to the company's CEO or president. People in finance must have certain traits and skills. One of the most important priorities is honesty. Managers and employees in the finance area must also have a strong background in accounting or mathematics, know how to use a computer to analyze data, and be an expert at both written and oral communication. Depending on qualifications, work experience, and education, starting salaries generally begin at $30,000 to $35,000 a year, but it is not uncommon for college graduates to earn higher salaries.